Two neighbors, same street, same month, same bank. Both buy identical new homes, each worth exactly $400,000. Neighbor 1 gets a mortgage rate of 6.25%. Neighbor 2 gets 7.25%, a 1% difference. Over 30 years, Neighbor 2 pays $88,000 more for the exact same asset. Same house, same bank, $88,000 more from one single number most people never try to change. Mortgage rates are the most searched financial topic in America right now, and yet most people who get a mortgage accept the first rate they are offered. They never negotiate, never compare, and rarely understand why their rate is what it is. In this video, we will map exactly how mortgage rates work, detailing the macroeconomic forces that move them up and down, identify your specific personal variables, and outline 4 exact maneuvers you can make right now to lower your rate by up to 1 full percent. On a typical $350,000 mortgage, a 1% lower rate saves you $71,000 over 30 years. Understanding this single financial mechanism offers a higher return than almost any other consumer financial decision you will ever make. A mortgage interest rate is strictly the rental cost of borrowing a lender's capital to acquire a property. When a lender gives you money to buy a house, they charge you a percentage fee for the privilege of using their funds. This chart shows the math on a $400,000 30-year fixed loan at a 6.5% rate. Your monthly payment for principal and interest is $2,528. Over 30 years, you pay back that initial $400,000 in principal, plus an additional $510,000 in pure interest. As of July 2026, the 30-year fixed rate ranges from 6.25% to 6.75% for well-qualified borrowers. Alternative products like the 15-year fixed and adjustable rate mortgages sit steadily lower. These numbers feel high when compared to the 2.75% rates of 2020 and 2021, but the historical average for a 30-year mortgage since 1971 is approximately 7.5%. The 3% era was a severe market anomaly, not the baseline. Because total interest systematically exceeds the initial asset price, optimizing the loan rate mathematically outweighs negotiating the home's purchase price. 6 forces drive that final rate. The first 4 are external economic variables that set the unchangeable baseline market rate. Force 1 is the 10-year Treasury yield. This is the foundational external signal for all mortgage pricing. This graph maps the Treasury yield at 4.4%. Mortgage rates track a 1.5 to 2-point spread above it. Add that spread to get today's 6.5% average. Force 2 is inflation. High inflation, like April's 3.8%, makes investors demand higher yields, pushing rates up. Force 3 is Federal Reserve policy. The Fed does not set mortgage rates directly. They strictly set the federal funds rate, which is an overnight lending rate used between banks. The Fed funds rate currently sits at 4.25% to 4.50%. If inflation continues cooling, industry forecasts predict 30-year fixed mortgage rates could fall to roughly 5.5% by the end of 2027. Force 4 is the bond market. Mortgages are bundled and sold to investors as mortgage-backed securities. Daily investor demand dictates hourly rate fluctuations. These 4 macro forces dictate the baseline rate of the market. They are completely out of your direct control. The final 2 forces are the personal variables. These dictate the specific premium you will pay on top of that baseline market rate. Force 6 is lender pricing. Different banks have different corporate profit margins and operational costs. Simply changing lenders alters a rate by 1/4 to 3/4% for the exact same borrower. But your credit score is the single heaviest personal variable. Dropping from a 760 score down to 640 pushes your rate from 6.25% to 7.50%. Over 30 years, that penalty costs you $90,000 in additional interest. Factor 2 is your down payment. Putting down less than 20% increases lender risk and triggers private mortgage insurance. PMI typically adds 0.5% to a full percent in extra annual costs. Factor 3 is loan type. If you are a veteran or active military, VA loans offer the absolute lowest rates available, consistently 1/4 to 0.5% below conventional loans. Factors 4 and 5 are your loan term and property type. A 15-year mortgage cuts total interest in half compared to a 30-year, and buying a primary residence avoids the steep rate penalties attached to investment properties. Mastering these microfactors shifts you from being a passive rate taker to an active rate optimizer. Here is how you apply this. There are 4 specific moves you can leverage these microforces and drop your baseline rate by up to 1 full percent. Move 1. Get at least 3 quotes. Rate shopping within a 14 to 45-day window counts as a single credit inquiry. You can compare multiple lenders without damaging your credit score. Move 2. Aggressively improve your credit before you apply. Pay your revolving credit card balances below 10% of their limit. Pushing a 680 score to a 760 secures roughly $39,000 in interest savings. Move 3. Buy mortgage points. This flowchart shows how paying 1% of your total loan amount upfront permanently lowers your rate by 0.25%. On a $300,000 loan, a $3,000 upfront payment drops your monthly bill by $49. The math here requires calculating your break-even point. Divide the $3,000 cost by your $49 monthly savings, and you get 61 months. If you stay in the home longer than 5 years, buying the points saves you money. If you move sooner, it costs you. Move 4. Time your rate lock strategically. Once you are under contract, watch for CPI inflation reports or Federal Reserve meetings. Rates historically react to this data. However, perfect market timing is impossible. The pragmatic strategy is to lock in a monthly payment you can comfortably afford today and refinance later if macroeconomic forces drop rates significantly. Proactive execution of these 4 moves mathematically offsets the market penalties that drag down average borrowers. There is one final pricing trap you need to understand: the difference between your interest rate and your APR. Your interest rate is strictly the cost of borrowing money. Your APR combines that base rate with all origination, broker, and closing fees. This creates a mathematical illusion. A lender offering 6.25% with steep fees may actually cost you more overall than a lender offering 6.5% with 0 fees. Always demand the federally standardized loan estimate document and compare the APRs between lenders, not just the base interest rates. You cannot control inflation. You cannot control the bond market. You cannot control the Fed. But you can control your credit score, your down payment, your timing, and your lender selection. Controlling these specific variables can shift your rate by a full percent, saving you $71,000 on a typical mortgage. Pull your credit report at annualcreditreport.com. Calculate your point break-evens. Subscribe to the channel for rigorous financial analysis. And drop a comment below. Are you looking to buy, refinance, or just learning for the future? We'll see you in the next video.
वीडियोस बनाने हैं फिल्मोरा है ना।